On to our next discussion, as most investors gather information from websites, newspaper, TV and find that certain investments have done well in the recent past. Everybody is talking about it, and then based on such information, they decide to follow the trend. After a few years, they realize that these investments are not performing up to their expectations and then reshuffle their portfolio. This happens because most of the times investors are chasing the best performing funds based on their recent returns. But should you really chase these funds, and are these metrics somewhat that you should really prioritize on? Let's discuss all of that with Misbah Baksamusa, who is the CEO of NJ Wealth. A very good evening, Mr. Misbah, and thank you so much for joining us today on ET Now. Firstly, because you have been interacting to a lot of investors out there, and what all information that is publicly available, be it different newspapers, websites, they also tend to show the returns in how the fund has performed in 1 year, 3 years, 5 years, and based on that, most of the investors go and just put their money. As per your experiences, why is this not the best strategy to follow and to put their money going forward?
Yeah, good evening. A very, very valid point that you have raised. So, as you rightly said that being into this industry since long, and the current scenario is that where a lot of information is available on the net. Investors do tend to see those information and try to invest into the funds or the schemes which are extremely good performer in the recent past. Even the data corroborates the very similar thing, that when we see the industry level data, a lot of money are invested into funds where we have seen good returns in the past. A recent example I can just tell you is that in the last quarter, if I see the industry trend, lots of money have gone into small cap funds and the mid cap funds, which have shown phenomenal returns in the last 1 or 2 years. Now, we have made our analysis, and which we share to a lot of our distributors and our investors, that the strategy of selecting the funds only looking into the past returns is extremely dangerous. Why is that if you see, or if you open any of the performance sheet, say we open a performance sheet 2 years before and see which are the funds which have performed good in that particular period of time, what typically happens is that in the next 1 or 2 years, the funds which was seen on the top on the performance chart actually comes to near bottom. So this has been a trend which we are actually been seeing very, very consistently over the past. So what really happens is that any investor who follows this particular way of investment, that my money should only be there into the top performing schemes of today, what they will try to do is that they will try to take off the money from the funds which are not so good performing at this in my portfolio, and would shift the money into the today's best performing funds, which would be completely destructive for an investor, because there is a very high possibility, based on the past data that we have seen, that the funds that we would have invested only seeing the returns tend not to perform. Secondly, people tend to forget the risk which the fund has, because of which also there are many times, they are not able to see the probable fall which can come into that particular fund if they invest into just seeing the returns. So yes, so the point is that it is very, very destructive to just follow the return charts, to return performances, and the select funds on the basis of those returns.
Misbah, thank you so much for highlighting, educating, as well as cautioning all our viewers that why this is not a great strategy to follow in terms of the past investment returns. But this question was just to set the context. The bigger question that we want to ask you and want to learn about, for the benefit of all our viewers, is that then what exactly investors should be looking at while investing? If not the past returns, then exactly what points they need to consider before investing in any of the funds? What are your major tick points over there?
So generally, there are a lot of research papers are there available in the market, which have been doing research for a long period of time. And most of the research reports that points out to is that end of the day, a return an investor makes over a longer period of time is a function of, or you can say 92% or 95% is dependent on the asset allocation that he decides, not the fund that he selects, right? Meaning that if an investor wants a return, or if an investor is expecting a return, or if the investor is needing the return, I think so the first question that he should plot in his portfolio is to what is my asset allocation of my portfolio. So the first and foremost thing, I think, and the most important thing every investor should do is to select a right asset allocation for himself. When I say asset allocation is that how much money should go into an equity or how much money should go into debt or any other asset class. But the first and foremost is, and the most important is the asset allocation, because this is going to determine the return that he is going to generate over a longer period of time. So this is the one thing which I would just point it out. Once the right asset allocation is decided, as I said before also, scheme selection is not very, very important. I will also share a few data points that we generally do. So when we take an analysis of, say, 20 years of the mutual fund history, and that we do it in the flexi cap fund and a lot of other funds, that category of the funds we have seen, there are hardly any difference between a top performing fund and the worst performing fund. So if I just say an example of a flexi cap fund, over the last 20 years, even the worst performing fund has given a return of 12.5%, where the average return is around 18%, and most of the funds are hovering between that 17 to 20% return band, right? Right, meaning that the fund performances over a longer period of time are not too volatile or not too different from the mean. So once you have set the asset allocation right, to select the funds within the asset allocation, I think so few simple principles which the investor needs to follow. A, try to keep money into diversified portfolios, meaning that flexi cap funds or the large or the multi cap funds or the large mid cap funds, where you have given liberty to a fund manager to decide which is the right asset or which is the right capitalized company I should invest into. We have given liberty to the fund managers. I think so large majority of the portfolios should be there into such kind of funds. B, select funds houses where you feel that these people are serious people, where you can give money and keep investment for long term. So select fund houses either with the help of a distributor or whatever information that you have. You select which are the fund houses where you can give money for a longer period of time. And the third important principle is very simple: diversify your investment even among the fund managers, right? So if you are following these four principles, where the first principle is the utmost important principle, that the first principle rule is that you have to decide the asset allocation, as 90% plus of your return on your investments is going to determine by the asset allocation that you have selected. As far as the fund selection is concerned, most of the portfolio should be diversified into the fund like flexi caps or the large and mid caps or the multi cap fund, where you give liberty to the fund managers, and it should be diversified across good asset managers. And of course, the principle always remains is that for return you need to have patience. Long term is the only solutions. Compounding only works in the long term. So this is what I have to say to the investors. But very, very important is that please don't chase fund returns or the performance.
Thank you so much, Mr. Misbah, for highlighting all these points out there for the benefit of our viewers. But when we are talking about watching out for the past performance, you would agree, Mr. Misbah, that we cannot completely ignore that. Definitely in the longer term period, if we look at 1 year, 3 years or 10 years, for one specific fund, it is not a great idea to actually look at the past performance, but how the fund overall has been performing, that becomes a critical part in terms of deciding the future success. So what should be the criteria of evaluating a fund not just evaluating the whole fund house and not just a particular fund that they are investing in, and amongst that, how should they evaluate that how a particular fund house has been performing, which are some of the major funds that they need to be tracking, be it from the large, small, or what is their strength over there, how to catch that part as well?
So honestly, in my last 20-25 years, it's fund selection is one thing which I have not really understood the science behind it. As I said before, uh, an investor should diversify their investment. So it should not be one fund house where all the money should be invested, because diversification is the only free lunch. Uh, Past performance in any scenario, if at all one has to see, it has to be seen more from a consistency level rather than purely a past performance. And if at all one has to see, I think so, we have to see as to how fund houses are serious in terms of managing the money, right? So if you feel that the fund houses are very serious, have stability in terms of their thought processes, in terms of their processes of managing the money, so these are few of the qualitative aspect which we typically see when we select a fund house for our investor. But again, as I said, it is a tricky job, right? And again, I would repeat that whatever my experience says, that in the long term, if we have selected good fund houses and been pretty consistent in our approach of asset allocation, and pretty consistent approach of diversifying our investors investment into good fund houses, you will never go wrong, as in the long term there would not be too much of a difference between two fund or three fund houses. And anyway, you are diversifying your investment, and it should serve a purpose of any investors. So that is what I would really say. It is very difficult to give a very right answer to this question.
Mr. Misbah, why I ask this, because in our query segment we get a lot of interactions. We do live interactions, and there we see that one particular investor has invested all his money in one particular fund house. So that was really interesting to get your take on this one. Why diversification is actually important to think on those lines. But before we go, Mr. Misbah, like you were mentioning in the start itself, that a lot of investors do look at the past performance, then they get disappointed, and then they actually make an investment in the funds which have not been performing well. So what are some of the red flags that post investing, how to actually scale that up, that your fund hasn't been performing that well or as per your expectation, and decide a point that they may need to make a switch then?
See, again, as I said, that if you are enoughly diversified, so I will not say that you are giving to 15-20 fund houses, but you have enoughly diversified, rightly diversified into 5, 6, 7 good fund houses. The fund houses are decently focused into what job they are supposed to be doing, and they are continuously doing that particular job, right? I don't think so an investor should be largely worried about by an underperformance, because my experience is that investors generally get perturbed or disturbed when you rightly say that most of the money is given to one particular fund house. They are largely perturbed when they select a fund which is of a very high risk. For example, the small caps, or the some investors I know that they would have invested a large amount of their portion into a sector fund, where because of seeing the recent performance, they would have invested a large portion of the money into a sector fund, where there are certain falls which they see, and that they are not able to digest the kind of underperformance vis-a-vis the other investments that they see. But if in general, if you have not made such kind of a mistake, if you have kept the money into the so called flexi caps, the multi caps kind of a fund, and diversified across 4 to 5 funds, I don't see any reason why there has to be a very red flags. Of course, red flags is only one. is that you come to know that this fund house is not focused fund house, or probably they have lost the focus into managing the investors' money. If that conviction that you develop, that these fund houses are not focused, then that's the only red flag which we see, which fortunately for us in a regulated environment, the things happening of such kind are very, very rare. But then too, yes, you probably need a distributor who can do at least such kind of an analysis where they at least see that the money which has been given to a fund house is fairly focused, fairly process oriented, and they are serious into managing investors' money. Baki performance may change. Performance, some fund may perform today, some fund may perform tomorrow. That is that rule of fund performance is changing is going to be a very, very permanent feature which we can't change. That has happened globally, and it is also going to happen in India. So nobody can change that particular rule. So if you get perturbed, if you continuously change the schemes based on the recent performance, as I said before also, there are larger chances that it would in fact kill the returns of an investor. It will it will affect the investor returns rather than helping the investors in terms of their returns.
Okay, Mr. Misbah, we'll let you go on that. Thank you so much for highlighting why an investor should not look at the past returns to decide the future performance, as well as what is the importance of diversification, and diversification not just for the fund, but for the fund houses also. Thank you so much for joining us today on ET Now.
Thank you. Thank you very much.
So that was all the discussion about that. Why should it really not be looking only at the past performance of any fund and going ahead decide that how it is expected to perform. Hope that helps all our viewers. But with this, viewers, it's time to slip into a short break. But don't go anywhere. We'll be right back with yet another interesting discussion with Shweta Jain of Investography. Stay tuned.